it's the latest sign that the private credit world could be facing a reckoning. Joining us now is Dan Rasmussen. He is founder and portfolio manager at Verdad Advisors. Dan, it's good to have you on here. It's, in the months that we've been talking about this issue as it's flared up, you can find folks that say, look, this is the front edge of a systemic credit issue the markets are going to have to deal with, all the way to the other end saying it's just a little bit of a liquidity mismatch, just kind of a logjam of some people who want out of a good asset class. Where do you come in?
This is the start of a big crisis. Rapid growth in lending never ends well. The private credit market was the darling of investors for about 15 years, about $2 trillion or so of new inflows, all went into very risky lending. This lending was generally done at 500 basis points, 500 to 650 basis point spread over SOFR. And it was done to companies, primarily leveraged buyouts that were taking on 5, 6 turns of EBITDA in terms of debt. Those are single B rated securities. Single B rated securities have a 20% 5-year default rate, according to Moody's. I expect default rates in private credit could be north of 20% over the next few years. I don't think investors are prepared for that. And once you start to see liquidity flowing out, remember, liquidity flowing in concealed all these problems on the way up. But now that liquidity is flowing out, we're going to see who's swimming naked, to cite the old proverb.
If your forecast of 20% defaults is right, Dan, is there, or what is the transmission mechanism to other parts of the economy and or the markets?
Well, this is in some sense the great success of the regulators. After 2008, the regulators said, hey, look, we don't want these bad LBO loans on the bank balance sheets, right? So it was a regulatory intervention. That was the origin story of private credit. The private credit investors then came out and said, look, this is a great market efficiency. Those stupid regulators have forced the banks to drop this highly profitable segment. Well, it's not highly profitable. It's cyclical. It looks good when there's low default rates, but the minute you have market stress, there's huge problems. And that's what we're seeing now.
And how are you, I guess, implementing this view at this point as the sponsors of a lot of these funds, the private asset managers, have seen their shares already, some of them cut in half. But how are you, implementing this as a trade?
Well, you've got to remember, first of all, that a lot of investors are stuck in interval funds and private credit funds that are still marked at NAV. So the public private credit firms, the BDCs, have traded down 30, 40%, right? But those interval funds are still marked at NAV. And so the first thing you're going to see is everybody that's in those interval funds trying to redeem at NAV. And as that money flows out, those outflows create their own problems, an inability to refinance, an inability to roll over new debt, liquidity issues at these funds. These problems are going to continue for a while. This asset class is nowhere near cheap. You never want to try to catch a falling knife. It's too early to even consider going long these vehicles on the premise that they're cheap. I think for now, the right answer is to use them as a hedge, highly risky credit, keep shorting it on the way down.
Are you short? Are you shorting the falling knife?
On the BDC ends, yes.
You are. Okay. Are there any in particular that you want to talk about?
I think right now we have a trade on the whole sector. I like the BDC ETF as an easy way to trade the whole sector. I think the problems are broad, and you want broad and diversified exposure.